those of you just joining, I'm Kelly Walts. I'm a VP of Underwriting here at Oaktree Funding, and we are happy to have you here. So I'm going to go ahead and get started here. So we're going to start off with we're going to talk all things non-QM. Now we do regular conforming loans, we do FHA loans, we do VA loans. We do all those in addition to non-QM, but as you probably know, if you've worked with us, non-QM is our specialty. That sets us apart from everybody else. And I think we pride ourselves in being common sense underwriting. We try to look at a big picture of things and try to think out of the box and how we can make a loan make sense and work together with our partners in business to make that happen. So we're going to talk about our non-QM programs. I'm going to touch on them and just like I said, give you a little bit of insight into what we're looking for and what we're looking at, and then ask questions as we go along. So does everybody see their question tab on the side? Because I may not be able to hear you well. My audio is not great. Hopefully you can hear me. If anybody can type in the questions, just say yes so I know you're alive and well. That would be great. Anybody? Yeah, okay, thank you, love it. Thank you guys so much for the interaction, I appreciate that. So, okay, so let's get started. So I'm gonna our basic program, which everybody knows is bank statements. That's a big thing right now is bank statement loans. And this is, as you probably know, primarily, well, it is for self-employed borrowers only. Let me start out with that, as if we don't, a lot of confusion, okay, can we please open up the channel for processors speak under, okay, we'll go with that a little bit. So let's talk about that. I appreciate that, and we are working on that. The communication is key. I completely agree with that. And so that is something that we will talk about. And thank you, Don Trump, for asking that question. So anyway, bank statements for self-employed borrowers only. Let's start with that. Okay, and so we can't use bank statements to document income for employed borrowers, even if somebody, their income is rental property, but if they're not a business. If they only own rental properties, but they're not self-employed, that's not going to be on the bank statement program. They would have to be business bank statements in order to use that program. Now we have 12 and 24 months and also personal and business bank accounts that we can use for calculating the income. So for what we're going to look for now, I want to clarify that we are looking at income deposits because that's where, you know, income that's generated from the business goes into the bank statements. However, we do look at the entire statement. So we also are going to look at what's going out of the account as far as expenses, liabilities. So keep that in mind that, again, we're trying to look at everything. We're taking a common sense approach. We're not taking just the regular pay stub W-2 approach. So, but we are going to look at all the documentation that is in there and the information that's given to us. So, you know, if you have questions on that, we're happy to answer it, but we are going to look at those. So if a bank statement, they say they have no employees, okay, because we're going to ask for a business narrative on the business bank statement program to tell us about the business, you know, what is it the business does, so we have an understanding of what we're looking at so we can calculate that income. And we're going to ask for a number of employees because, again, we're trying to figure out on any income, we're trying to figure out what income they're going to have to make the payments on the loan that they're asking for, that they're applying for. And so we're trying to figure out what that is going to look like, what they're going to have left over after paying for the expenses of their business in order to make the payments on the loan. So we ask about employees because that's a huge expense. And I will touch on that. It's a great question. So, and so on the business narrative, that's one of the questions asked is if they have employees. Now, we also are going to look at those bank statements to see if there's payroll expenses going out of that. And so if we have a business narrative that says 0 employees, we're going to look at that, which we're going to look at the bank statement anyway. But if we see payroll expenses coming out of that account, we're going to ask about that. We're going to say, okay, it looks like there's payroll expenses. What is this? How, you know, who's getting paid to? Oftentimes, we can see, you know, it'll say pay to, you know, it'll have different names. So we'll see 5 names every other week of payments going out. So we know that there's probably 5 employees. So we are going to look at that. So I want to make sure everybody's aware of that. And then you can look at it too, because if you're looking at the same thing that we're looking at, that again, that makes everybody's life easier. Now, Mark asked a couple questions, is how do you know if you should use 12 months or 24 months? I think there is a pricing difference between the 12 and 24, but let me tell you how we're going to look at it as far as the income standpoint. There's a couple different ways. 12-month statements, if the income is, say if we have 24-month statements and the income is lower in the most recent 12 months, we're going to take the 12-month average, okay? Because we're going to use the most recent income, which is lower. If it's the same or similar, we're going to average it over the full 24 months. Now, let me tell you, if you send just 12 months, we might ask you for also the previous 12 months, because we're looking at that point, we're looking for seasonality of income. We're looking to see some income is completely sporadic. And so we're looking for those patterns so that we know what income that we can rely on. If you work with us, a lot of times we talk about declining income. And that's a big deal. I mean, Fannie talks about that. Every loan type looks at declining income. Now, what we might ask for the previous 12-month statements is if it looks like in the most recent 12 months, it looks like their income has declined in the most recent 6 months, which could be problematic. We may ask you for the previous 12 months to see, you know what, it's not declining. This is just how their business works. They're a roofer, so their income is lower in the winter than it is in the summer. Makes complete sense. So instead of using the 6 months income, we're going to average it over the 12 months or the 24 months, and we'll calculate income that way. Now, again, we're looking for what the borrower actually makes. We're looking for what makes sense. So even though our guidelines say that if 6 months declining and we have to use that income for qualifying, if it makes sense to use the 12 months or the 24 months average, then we'll look at that too. So we want to have the big picture, and we want to calculate the income accurately for what the borrower is going to have in order to have that income to make their payments going forward. Mark Luna also asked the question, would you also look at 2 years 1099s as an option? Absolutely, that is on our list here of 1099s. And might as well touch on that now since we asked the question. Now, a 1099 income is good for somebody that doesn't actually own a business, but they are self-employed, meaning they file Schedule C on their taxes. Realtors are good examples of that. If they work for a broker, like a real estate company, but they're a realtor, and there's different kinds of that as well. Salespeople oftentimes are paid 1099. They don't own the company where they work for, but they get paid 1099, so they file Schedule C. So technically, they are self-employed. And so we would use the 1099s, and we know there's a lower expense factor because they don't own the business, and so we're going to use a lower expense factor in calculating that 1099 income. Let's see here. Great question so far. Appraiser in his 1099 with hardly any expenses. His business ebbs and flows somewhat. My 2 years, 1040s, 2 years, 1099, of course, bank statements. So those would all be options for calculating the income. Oftentimes the reason people don't want to, because obviously if they, they file the Schedule C tax on their tax returns, but a lot of times people write things off, as we know, so that they pay less taxes, but they actually keep more of the income but what they're filing on their tax returns. So we're looking for what they actually will file. Now, we do, as a rule, use an expense factor for 1099 employees of 15%. So, which is low, because you figure even if you're, like in your example here, Mark, an appraiser, now he probably does have low expenses, but he still has to go on the field. He still has gas. He has to pay for his computer software to generate that. He may have somebody help him type up appraisals. I know, some of the appraisers have assistants that they do type up so they can just be out in the field. So there's different things we're looking at, and we want to allow for that. And again, we're trying to make sense. We're trying to get to actual income that they are going to have to use to make the payments. We don't want to set anybody up to fail. We don't want them to fail. We don't want, you don't, we don't, nobody wants them to fail. And so we're looking to what they actually will have, as close to it. Obviously, we're estimating, but close to it to be able to make their payments. So these are quite great questions, and I appreciate the questions coming in. If no other questions on bank statements, I'll move on. And And okay, same question. And again, feel free to even go back. So second mortgages, we also are in the second mortgage business now. We do both standalone seconds and we do HELOCs as well. And so these are really popular right now and maybe even becoming more popular because of the rates. You know, those that, you know, refinance or bought a house a few years ago when the rates were 3%, they probably not going to want to do a cash out refi and lose that low rate that they have. However, they want to tap into the equity they have in their home for whatever reason. And so they have the availability of a second mortgage or a HELOC. And so that allows them to tap into that equity and to obtain it and use it for other purposes without affecting their first mortgage rate. Now, also that obviously because the rates are higher right now and they probably are going to come down at some point because they always do, that sets us up for more business in the future and being able to refinance those as well. And so that's, you know, another way to look at it and to keep marketing those. We do offer bank statement seconds. Yes, we do. And that works basically the same as our first mortgages. And, you know, the 12 months or the 24 months. K1s, do you need entire tax file or just the K1? Great question. So if somebody gets K1 income, that will show their percentage of ownership they have in that business. And if they own 25% or more on that K1 of that business, then we will need the business tax returns. So we will ask for that. And if they own less than 25%, we don't need it. So say we see a lot of, say, Kaiser doctors, and they have their own business. They get paid a K1 through Kaiser, but their ownership is very low percentage. And so we don't ask for the business tax returns. We just get their K1 that goes along with their personal tax returns on their Schedule E, and then we're going to use that to calculate the income. So these are great questions. Can you do a second stated program for real estate investor and the 80% cash out? So second stated program. Stated meaning stated income without documentation, no. If that's what you're referring to, bank statements, yes. 1099s, yes. We can do that, but just a stated income, no. Real estate investor, if you're talking bank statements, if they have a business and that's their business, then yeah, we can use the bank statements for that income. All right, moving on. Thank you. Keep these questions coming. And what is the best you can do suggestions? That one you might want to talk to your AE so we can get more details on what it is exactly that you're looking for. So whoever your account executive is, they can probably help you kind of sift through the options based on your scenario, because there's a lot of different things that go into determining what is the best program. So I would get with your AE and we can help with that. And the AEs can always, if they need help from me, they know they can call me, come in, whatever it is, and we can all work on it together. I think I talked to I don't know how many brokers yesterday with the AE on the line. We kind of did a three-way call to kind of go through the scenario and figure out how we can put our heads together and come up with a solution. So feel free to do that as well. The next program, will he need a CPA letter? More than likely, on most of our bank statement programs, 1099 programs, we probably will need a CPA letter because we do still have to verify 2 years employment. We do still have to verify ownership percentage, and a CPA letter can help with those things. So yeah, more than likely we will. There are other ways. If it is like an LLC, they can provide an operating agreement that will show ownership percentage and how long, when they started the business, if they have it since then. So we have different options on how to verify that, but a CPA letter is one of those options oftentimes. The next program we'll talk about is DSCR, which also stands for debt service coverage ratio. Now, what this program is we're not going to income qualify this borrower. Okay, we're going to, the property basically is qualifying. We're going to look at the borrower's credit, but the property basically is qualifying for the loan, the income generated from the property. Now, a couple things I want to touch on. This program is not designed for first-time home buyers. So we typically, the person owns their home, they live in their home, but they want to buy a rental property, and this property is in a good area that generates good rent, that supports the payment, and so they want to purchase the property without providing all their income documentation. That would be somebody, as long as their credit was good, that would qualify for this program, DSCR program, because the income generated from that property supports the debt that's going to be generated with that property with the new loan. Again, so since we're not looking at the ability to repay, because we're not asking for any income documentation, the property is to be in decent shape. And so this is not also a program for a property that needs all kinds of work done on it, and they're just looking to pull cash out, buy this property, whatever the property needs. Because we're looking at only credit and only property, the property needs to be in pretty decent condition. So keep that in mind. Do we need to provide credit for it? Yes, we do. Usually the brokers provide the credit report. Mark, thank you so much. I appreciate your asking these questions, because this is helping me know that you're out there, and I obviously want to hit what your questions are and make sure that I'm covering that. So thank you for this. Yes, we do need a credit report for that, and typically the brokers provide the credit report. And so we will check that. We want to still see their, we don't look at their ability to repay, but we want to look at their willingness to repay their debt. So, and that's what the credit report provides, is they take out debt, they make their payments on time, and so we can feel pretty confident that they're going to pay back the loan that we're giving them as well. The lowest DSCR ratio is what I'm assuming you're asking, Bridget. The lowest DSCR. We do have, our guidelines state the minimum is 0.75. We do have a program that's a no ratio DSCR program. And so you want to talk to your AE about that, but we do have options for that. There typically is like a pricing hit for it. There may be an LTV hit as well, but we do have that available. So yes, we can. And so check that out and talk with your AE on how we could help with that. But that is an option. Let's see, any other questions on DSCR? I want to hit on again is first-time home buyers an issue on those. So, that's really not what it's designed for. Somebody that's buying their first house, we really want to see that they have had a house payment before and that they have experience managing that kind of debt and making payments on time. And so we do not particularly like first-time home buyers. We have made exceptions. Again, when it makes sense, our guidelines state that they have to live in a high-cost area. And so that makes sense. If somebody lives in for instance, my daughter lives in Los Angeles in the city, and it's so expensive to buy there. So she'll buy a house out in the suburbs, but she works in LA, so she can't necessarily commute that far. So that might make sense. But again, it's something out of the box that we will look at that has to make sense, but it's not our go-to for that program. It's not really what the program's designed for. Do you take the lowest of the 1007 or least or the highest? Great question. Typically, we're going to take the lower. Well, we're going to take the lower of the actual or the market rent. Okay, so we will take the lower of the two. Now, oftentimes, the market rent will be whatever it is. Say the market rent's $2,000, but they have a tenant in that property, and they've had that tenant in there that's paying $2,200, $2,300, whatever it is. Their actual rent's higher. So we can use the higher of the two if we can document with a copy of the lease and receipt of the rental payments or rental income that they've been receiving for that property. So we start with the lowest of the two, but if the actual rent is higher and it can be documented, we will consider using that even though it's higher than the market rent. Great questions. Thank you guys for that. ITIN borrowers. This is for borrowers that don't have a Social Security number, but they are here legally. They're here, they're working, but they don't have a Social Security number. They haven't gotten that far in the process, but they have an ITIN. They're filing their taxes with their ITIN, and so they're doing what they're supposed to, but they haven't gone through the Social Security number and all that residency stuff yet. So we do offer those as well. I see another question coming in. care about declining market for DSCR? We do, because again, we're on a DSCR loan, our property is the collateral. That's basically what we're making our decision on for the loan. So we are going to look at a declining market. We do have a 5% LTV hit for those. So we will do them. So we can allow them, but there will be a 5% LTV reduction for a property that's in a declining market. So great question. Blanket mortgages. This is something that a lot of companies don't do. And we've done quite a few of them. They make a sense for borrowers that own a lot of properties and they want to do just one loan for multiple properties. And so we do that. We do allow them. The loan can be a mixture of purchase and refis in the same loan. The properties do need to be in the same state. It's good for, and we do up to 25 loans, 25 properties under one loan. The minimum loan about that for that is $400,000, but it's we do condos and houses under the same loan, so we can do both. So we do cover those properties. Let's see. Eric asked a question. Can you cover ITIN in details? Well, let's see. Details meaning they have to have an ITIN issued to them. They had to have had it for be in the States and then lived in the States for at least 2 years. We still are going to verify employment for 2 years. They still have to have credit, and their credit needs to be under their ITIN number. So back in the day, before they had ITIN, before they did that, a lot of people were using Social Security numbers that weren't issued to them. And so, but credit under those Social Security numbers are not allowed to be used on that program. So that's something to keep in mind, that it has to be credit under their own ITIN number. And we can't have any other Social Security numbers that don't belong to them on the credit, on the file, on the income and all that. It has to be under their ITIN number that's issued to them by the government. And yeah, we can do those programs, bank statements and 1099 under that program as well. So DTI requirements are going to be the same. LTV is going to depend on what their credit score is and all of that. Your account executive would be happy to give you all of those details, but we can do those. So we're happy to answer specific questions for specific transactions that you have and see what we can work out for you. So please ask those questions with your AE and we'll be happy to figure out how we can make it work. Moving on, and keep those questions coming. Asset depletion. Oh, do we have any questions on blanket mortgages? A lot of people don't know about those and don't, have never done them and think that they're complicated. They're basically a DSCR loan, and you're doing one loan with multiple properties. So you're still getting all the appraisals. You're still getting a prelim with all the properties on it. So you're doing all the same things as a regular DSCR loan. So we are qualifying the property based on the DSCR ratio. And there is a minimum required. DSCR on that one, it's 1% or 100% for each individual property and 1.2 overall. So so what that's for the commercial or for the blanket loan. Aggressive, or do you shy away from second equity loans in Texas? So we actually can do them for investment properties, and we can do seconds and then HELOCs as well. So we follow whatever Texas guidelines allow. Okay, and so we do have to watch out for the cash out programs. So for Texas and the laws that they have, but we do allow it where it is allowed. We do them where it's allowed. So yeah, we don't shy away from them. We will do them. If they're allowed, then we will do them. So I hope that answered the question. Did I answer the other question? Blanket loan. So if a borrower wants to do a loan on 10 properties, would you require 10 appraisals, or would you allow AVMs to keep the cost down? We do require, and this is a great question, John, thank you. We do require an appraisal on all of the properties. So again, we're not income qualifying. We are looking at the credit just like a regular DSCR loan, but the property is qualifying. And so we need an appraisal to make sure that the property is acceptable to be as collateral for that loan, since that's basically what we're hanging our hat on. So we do require full appraisal, and if there were 10 properties in that cross-collateral loan, we would require 10 appraisals, so an appraisal for each property individually. And the appraisal would need to have a 1007, the rent schedule for that as well. So we will allow that. Now, as far as a prelim, we just have one with all 10 properties on it. CPL, just one with all 10 properties on it. Let's see. Do we do balloon mortgage loans or other non-QM or sellable mortgage loans? Well, not necessarily. So I'm not sure specifically on the question on that. So no. I would say no to that. I'm not sure exactly what you're asking, but we get with your AE, and I hate saying no, and the answer is actually yes, but I don't have the full details. But get with your AE to get the full details on that, and we'll see what we can do. Let's see here. Moving on, asset depletion. Now, what's the minimum score for 90% LTV for bank statements program? That you're probably going to want to get with the AE, because it's going to depend on, here, let me see if I can get that real quick here. Oh, okay, I don't want to mess up my system here. But what lender? Oh, sorry to ask, but what lender are you with? We're with Oaktree Funding. So if you're just joining us, this is Oaktree Funding, and I'm Kelly Walts, the VP of Underwriting here at Oaktree. So that was a good question, Eric. So welcome, glad to have you here. Asset depletion. So asset depletion is calculating income based on borrower's assets. So borrower has significant assets, and they want to use that as income for qualifying. And we do allow that, we can use that in addition to our regular income as well. So if you have a W-2 person earning income, they also can, and they have significant assets, we can use those assets to add to the income that they already have to help them qualify. Now, a couple things to keep in mind for asset depletion is we're going to require 6 months seasoning for the funds that we use for asset depletion, which means we're going to ask for 6 month statements. And we're going to use the lowest balance on those 6 month statements, because that's the amount of funds that are seasoned for at least the 6 months. So, and that's what we're going to use to calculate that income. Another thing to look for that people often forget assets for asset depletion is if you have those high net worth borrowers or high liquid borrowers on those statements, oftentimes they'll invest in options, they'll take out margin loans to, for investing. So keep an eye out on those things on those asset statements. So if they have options, if they have margins, that they're using their assets again, or they're using those assets for collateral. Look for that on the statements, because if those assets are tied up in any of those things, tied up in options or margin loans or as collateral for another type of loan, we cannot use those assets for calculating income, because those assets aren't actually available. They're used for other purposes. So keep an eye out for that on bank statements. Questions, let me see. Can any shortfall in DSCR cash flow made up with assets like an asset depletion? No, we can't use that. It has to be on a DSCR loan. It's the property that's actually has to generate that income to support the payment on that, because we're not getting any income documentation for that. So no, we wouldn't look at shortfall from other assets like asset depletion. It would be the property that needs to work on that or to support that. Asset depletion be used for a primary, second home and investment. Yeah, it can be used for that. So we do allow the asset depletion income to be used for those different purposes. So yes, we can. As a small, are you doing commercial mortgage loans? No. So I'm gonna touch on that here under our multifamily. So commercial loans, we don't do commercial loans. We're a residential lender. However, we do mixed use properties. And so mixed use means it's partially commercial use and then partially residential use. And we consider that part of our professional investor program. It's also under multifamily. So we do loans from 5 to 8 units as well as 1 to 4, which is typical single family, but we do multifamily and mixed use. Now, one thing to keep in mind for mixed use, so we do, it can be, a portion of it can be commercial, but only 49% of the total property can be used for a commercial purpose, because we are still a residential lender and residential loans. And so the 51% of the property needs to be for residential purpose, but 49% can be for commercial purpose. So keep that in mind if you're coming across a mixed use. We don't do commercial in general. We are still a residential lender. But we do quite a few mixed use properties, and we're happy to do them. We have some great investors that we work with on those. We've been able to, I say 5 to 8 properties. We've actually been able to lend on 10 properties. We've done more because, again, we work closely with our investors to try and do loans that make sense. We want to all do loans that make sense. And so we do have flexibility on that. Not huge flexibility, but because we are still residential, so we got to keep that in mind as well. Do you loan on non-warrantable condos? We do loan on non-warrantable condos. And I actually have that on, I think on our next screen, slide, we're going to talk about that a little bit more detail. So I will touch on that in a moment. Let's see here. I'm going to move along on the slide here. 1099s, we touched on that already. So we'll go past that. Multifamily, I just touched on that. So the 5 to 8 units and also mixed use properties. We do those and we're happy to look at them. Condo litigation, okay. That's a great question. And the answer is it depends. And I know you probably want a more black and white answer, but there really isn't one. So if the litigation pertains to something having to do with any structural integrity of the property, anything wrong with the property itself or the project itself, then we're not going to be able to do it. However, if it's because so-and-so sued the HOA because their neighbor was playing their music too loud, or they slipped and fell, anything that's not having to do with the structure of the property, then we can consider that. So if you have that, give us the details of it. We're happy to take a look at it and see if it's something that we could work with. So yeah, the answer is not straight no. It really depends. So let's see here, non-agency. Okay, so that's what we're talking about. Loans not sold to government entities like Fannie, Freddie, FHA, VA. We do those loans, but today that's not what we're talking about. We're talking about non-QM, so we'll move past that. Let's see, HELOC, I touched on that already. That's a way to tap into equity, and for maybe they know that they're going to use it down the road. They don't need the complete amount right now. Say they want to take out $200,000 in equity. They only going to use part of it now, and the part of it have that line of credit open for future use. We can do that. So that's an option as well. Foreign nationals, we do those. We do allow foreign national loans. And so that's in our guidelines as well. And so check that out. It would obviously be for a investment property or second home. We are still going to look for credit on that. It can be foreign credit, but we will still need credit trade lines will provide that. Any documentation that is in a different language would need to be translated, so certified translator. So just keep that in mind. Question we have here, current maintenance repairs are in progress, like painting buildings and other repairs to common areas. If it's something like that, painting, then we're probably okay with that. And it just depends on the circumstance. If it's something major under repair, we may not. If it's something structural, it's something we would have to take a look at that specifically. But if it's going through repairs and they're just painting because they're updating the paint on the outside of the property, then that's probably not a problem. But we're happy to look at that more specifically and see if it makes sense and we can do it. All right, moving on, exceptions. Now, one thing that is good about non-QM loans is that not everything is black and white. Okay, like if you're FHA conforming, you know, these are their guidelines, you gotta follow these guidelines and that's it. Where we have a lot more flexibility, as I mentioned before, with non-QM loans, and we work closely with our investors to do make sense loans. So we do offer exceptions. And one that we just talked about, somebody had a question about, is investor concentration for condos and non-warrantable condos. And we do non-warrantable condos. An example of an exception that we did recently is our non-warrantable guidelines allow up to 60% investor concentration. Well, we can go up higher than, we've actually done considerably higher than that investor concentration for a project that it was common for that project. It was a well-known vacation area, and it just made sense that there's going to be a higher investor concentration. And so we were able to make that exception because it made sense. Another exception that we allowed is our DSCR properties. I know our guidelines say the max is 2 acres. We have made exceptions for more than 2 acres and actually up to 20 acres. We have done on a DSCR loan. And again, it's just got to make sense. The property's got to support it. We need to make sure if it's acreage, something to that effect, that's not a commercial farm. It's not being used for commercial purposes. It's a residential purpose. But we do, you know, we want to look at loans and we want to do make sense loans. And so even if they're slightly outside the box, we'll take a look at it. We look at exceptions every single day. And that's something that it's, you know, we pride ourselves that we want to do loans that make sense. And so we're not just going to black and white, this is it. You know, we're not doing it. No, if it makes sense and we can document the file, again, it all comes down to documentation and what you can do and what you can prove, what you can and document. So we will look at that and we will consider exceptions. There are some things that are hard nosed. We're not going to go above typically a DTI 50%. Our guidelines do allow up to 55% for primary residences as long as it meets all of the qualifications for that. But typically it's a 50% DTI. We're not, that's usually a hard line for that. But a lot of other things are, you know, need to make sense. For exceptions, we do require 2 compensating factors. And what that means is if we want to go outside the guidelines, then we need some strength in the file to make up for going outside the weakness in the file. And so say our, you know, say the example of the investor concentration. Okay, we're going to go for warrantable condos, it's 50% investor concentration is allowed. For non-warrantable, it's 60% investor concentration allowed. But we want to go a little bit higher than that. And we look at the property, we look at the appraisal, we look at the HOA docs, and it makes sense to do that. So in order to make up for that weakness in the file, something outside of our guidelines, we're going to look for compensating factors that are going to provide additional strength to the property or to the loan. So that could be additional reserves. It could be the loan to value is lower than what the max allows for that program. It could be, you know, they have never had any late payments on their credit. It could be they've been on their job for 10 years and, you know, so that's a strength. So we're going to look at the different strengths in the file to make up for maybe a weak area that we have to, again, make the loan make sense. So, and we want to look at those different scenarios so that, you know, again, so we're not losing loans that we don't need to lose, that other other companies may say no to. We want to say, okay, well, can we make sense of it? Can we document this scenario? And then if we can, let's do it. If you begin a DSCR loan and discover an issue in underwriting or something that will not work, can you switch gears into asset depletion, no ratio, or something else to make that? So that to work, or is a deal dead? So that's a good question, and that's kind of a loaded question. Okay, so if we have a DSCR loan and for some reason it doesn't make sense to go DSCR, they're say a first-time home buyer, and so we can't go DSCR or whatever the case may be, yes, we can transfer or switch it to a income qualifying loan. However, it would need to be restarted. So that loan would need to be canceled, and we would restart the loan as an income qualifying loan. Because there's different disclosures that are required, and 1003 is required with the income documentation or income information that wouldn't be supplied on a DSCR loan. So yes, we do have the ability to do that, but we would need to restart the loan. And so let's see, for current cash out refi, I'm not sure to make a deal for a current cash. I'm not sure that of the full question on that, Mark. If you want to give me a little bit more details, I'll see if I can answer that. But so no, the deal's not dead. We want to figure out a way to make it work. So yeah, we can switch as related to it. But okay, so yeah, so cash out refi, if it came in as a DSCR, but we need to switch to income qualifying, yeah, we can do that. And so, like I said, we would just need to cancel that loan out, restart the loan. We would transfer the documentation to the new loan and send out the disclosures so that everything has all the required disclosures that are needed. The 1003 has the income that we need to qualify. So yeah, we absolutely would be able to do that and would welcome that. All right, so moving on, appraisals. I'm not gonna talk a lot about this, but I just kind of want to touch on, kind of the process. The appraisals ordered through our appraisal team. We actually have a team dedicated to that who will help with that and go through the process. The appraisal, when it says completed, we'll send it out to your borrower as they're required to make sure that they get their copy of it. We'll send a copy to you of it so everybody has the appraisal and knows what the value is, can look at it to see if there's any repairs required, whatever it is, you have that copy for you. And then we upload the file to the appraisal to the file, so it goes to underwriting. So we will underwrite the appraisal without all the other documents. So as you're aware, we have, we like to review, we don't like to review conditions, piece by piece as they come in. We like to have the full file because to look at the file, because we're looking at it as a whole anyway, and it's more efficient time-wise to look at more things at once, but with the exception of the appraisal. So once the appraisal is uploaded to the file, it does go into condition review status for the underwriter to look at that appraisal, and we will review that by itself and then send out updated approval with any appraisal conditions or just that appraisal conditions signed off, and then the other conditions remain. So we will do that. So just so you know. Documentation, I know we're getting to the end of our time here, so I'm kind of moving kind of quickly. We're almost done though. So documentation requirements, we kind of just wanted to touch on this so everybody has the same, the same expectation. We are going to need borrower's driver's license. This is basic for every type of loan. Social security number, we need that for every loan. That's normal. Income verification. As you know, we have the different ways to look at it. We can full doc, which is pay stubs, 30 days worth, W-2s, tax returns, VOE, possibly if it's needed. It's not always needed. We can go with just pay stubs and W-2s if there's not a variable type income. So we don't always need a VOE. We do ask for transcripts if we have W-2s in the file or tax returns in the file. We will get transcripts on those. So just keep that in mind. Right now, we're kind of that in-between time where taxes were just due to be filed in April. However, not everybody filed. A lot of people filed extension. So we will ask for a copy of the extension and the transcript showing no record of account file or record filed. We'll ask for that, in which case we would require then the previous year or 2 years, depending which way you're going, tax returns, and then a P&L for 23 if they have not filed their taxes, and also a year-to-date P&L. So that's something that would require for self-employed borrowers if they did not file their 23 taxes. Let's see, we have on here also, if you have bonus, other type of income, any type of variable income, there will be, we will need a VOE because we will need that income broken down, and that's the same as, conforming FHA, type loans. We will need to separate out bonus income, overtime income, because that is different and often does vary. So we will need to average that income, again, which is the same in non-QM and conforming loans. Debt obligations, we're going to look at the credit report. Something to keep in mind is for student loans, conforming loans and non-QM loans, we will count if there's no payment. So if their student loans are in deferment, and so there's no payment listed on the credit report for conforming and also non-QM loans, we will use 0.5% of the balance for a payment. However, on second mortgages, we will use 1% of the balance for a payment. So I wanted to kind of make that differentiation because that does affect qualifying. So I wanted to make sure everybody knew about that. It is on our matrix, and so it is good to check that out, especially on our closed-end second and our HELOC program. A lot of the requirements and guidelines are on that matrix, so make sure you're checking out those matrices for those kind of little different things, different requirements. Purchase agreement, that's going to be typical for all loans. You know, we're going to need the purchase contract executed by all parties, any addendums, counteroffers, and all of that. Homeowners insurance, I see mentioned here. Remember on DSCR loans always, but on investment property loans where we're using rental income to qualify, we will need 6 months of rent loss insurance. So make sure if your homeowners policy includes that. So it covers 6 months of the rental income payments. So not the mortgage payment, but the rental income that we're using to qualify that borrower, either as DSCR or even income qualifying if we are using rental income. We do need that rent loss coverage on their homeowners insurance policy. It needs to cover at least 6 months worth of rental income. Self-employed borrowers, I already touched on this, the profit and loss statement, tax returns, balance sheet. A balance sheet we don't always need for a self-employed borrower, but we will need it if we are using assets to close from a business account and they're not able to get a letter from a CPA stating that the use of business funds will not have a negative effect on their business. They can provide a balance sheet in lieu of that, so we can evaluate the liquidity of that business. Well, the thing we don't want to do is somebody taking all their money out of their business and they need that money from their business to, you know, buy their inventory or whatever it is that they use to manage their business, to operate their business. So we don't want to put them in a position to, you know, affect their income coming, and that's going to help them make the payments on the loan they're going to get. So, so we will ask for a balance sheet if we don't have a CPA to evaluate that. We will ask for that balance sheet to evaluate that on our own. Let's see here. We've got 5 minutes left here. So any other questions? This is just kind of basic loan terms that we included in here for new people. Let's see here. How do you calculate income when overtime is not consistent within 2 years? Great question, Charles. Thank you for that. What we're going to do is it's not consistent, we're going to average it. And that's very common in a lot of types of business, say a UPS worker. So they are crazy busy during the holidays, as we know. And so they're going to make a lot of overtime probably during holidays when they're working crazy hours, but their overtime may be slow during the other parts of the year. And so, so we will average that over the year. So we're going to look at the whole year and we're going to average it out. So we know that, you know, maybe their overtime is $1,000 a month in addition to their base pay in the winter time, but summer is you know, $100 or none. So we're going to average that out to kind of see what they will have to use over the course of the year in order to use for qualifying. Let's see, can we use settle-wise for title escrow on a refi? Are you talking about for smart fees in order to, I'm not sure of that question. And so obviously I'm not on that end of it. So I'm not sure of that answer, but we'll be happy to get that answer for you. And if it's smart fees, which is what we call them, then yes, we can do that front. And obviously we'll use actual fees later. What's typically max LTV for second mortgages with bank statements? It's going to depend on the credit. So we do go up to 90% CLTV on those, but it depends on the credit and, you know, the full circumstances of the loan. So we will look at the loan as a whole. But great question. But typically it's 90% for that max CLTV. Any other questions? We're doing great on time. Anybody else have anything that you want a little bit more details on? Because I did kind of move quickly through things because I wanted to make sure to touch on everything. And if we have no more questions, that I cover all the questions. Okay, thank you, Bridget. I appreciate that feedback. So if we have no more questions, I'll hang here for just a couple minutes in case anybody wants to stick around and ask some more questions. But thank you all for joining us. We're happy to have you. We're happy to have you as partners. We're in this together, this tough market right now. We realize this market is really tough. We're all having to work a little harder than maybe we did a few years ago, but we're in the trenches with you. We're happy to work through it with you. We're happy to look at all those tough deals and see what we can figure out together, put all of our heads together, and see, you know, how we can make things work. What's the differentiator between Oaktree and Angel Oak? Honestly, I can't speak to Angel Oak. I don't work there. I've never worked there. So I don't really know what differentiates for them, other than I can tell you from us, we are common sense. We want to make good loans. We want to make them work. We want to figure out the documentation. And I know that's probably not typically heard from an underwriter, but they, you know, typically underwriters are black and white guidelines, and trust me, that's our kind of our personalities to come that way. But at the same time, you know, we want to work as a team together, and we want to figure out how to make these good loans work. And so we're, as a team, we're going to look at it as a team. And like I said, we do it all the time, is we'll get all of us together on a call, like, okay, what can we do here? Is there a chance? Do we have a shot? What can we do to make this work? And so we want to be your team member. We want to be on your team. We want to work together and make it happen. So give us a chance to get those loans to us, to give us a chance to make them work, and see what we can do to get them closed. So thank you, everybody, for joining us. Happy to be your partner, and thank you. Have a great rest of your day. LTV first. Okay, we got that one. Let's see what else we got. Thank you, Mark, for all your questions. I appreciate it. Let's see. Thank you, John. Appreciate that. Thanks for the feedback. Oh, thank you, Don, for asking that question. So we try to. We're working on that, I should say. So the reason we don't do that is we want the underwriters to get the most done possible. And if they're getting interrupted all day long, they're not able to get through the loans. And plus, sometimes you need that uninterrupted time to get through, especially the tough loans that we have right now in the market. You need that time to kind of focus and get through those. So we are working on a scenario for that, on how we can work through that. I am available, and so you get with your AE, and they know they can call me, and we'll do it on a three-way call. And that's we offer for now. We are looking at different ideas for that, but we do want to work together. We want underwriting and you to work together. So we're looking at different solutions for that. But for now, I'm happy to help you with your AE, and we'll look at it together. So. Okay, I'm writing your number down, Don, so I will give you a call. All right, thank you, and we will give you a call. Do you know who is your AE, Don? And thank you, Diana, I appreciate that. Appreciate that feedback. And thank you, Michael, I appreciate that as well. 1 year W-2, would it be acceptable with conventional loan to qualify? Yeah, on conventional loan, that goes to your findings. And so if they've been self-employed for 5 years or employed for, yeah, most of the time you're going to get 1 year W-2 feedback for that. So so typically, yeah, if they've been working for, but they still have to have 2 years employment. So let me clarify. Yes, we may be able to qualify with the pay stub, year-to-date pay stubs, and 1 year W-2. However, However, they do still have to have 2 years employment history. And so there is a difference there. So I want to make sure. Oh, okay. Ashley, thank you. All right. So I appreciate that, Ashley. And Owen, we'll get with Owen and we will get on a call together to talk about that. I think Owen's on here too. He was threatening to heckle me while I was on here. All right, Ashley, we'll give you a call. Let's see. He made you on. Well, tell him thanks. Yeah, he knows that how much I love talking in front of people, so he probably is doing it to torture me even more. But I appreciate your questions and thank you for joining us. We're happy to have you. All right, anything else? What's left? All right, guys, thank you. I think there's only a couple of you left here. I'm going to go ahead and sign off unless anybody has any more questions. All right, everyone. Thank you again for joining us. Bye-bye.